How to start investing. Investing can be a daunting and confusing process, especially for those who are new to the world of finance. However, the rewards of investing can be significant and long-lasting, and with the right guidance and education, anyone can start investing successfully. That's why How to Start Investing was written to give you the tools and knowledge you need to make informed decisions about your money and grow your wealth over time. In this book, you'll learn the basics of investing, including different types of investments and the risks and benefits associated with each. You'll also get a comprehensive overview of the key factors that impact the performance of investments, such as interest rates, inflation, and market trends. And you'll discover practical, actionable strategies for building and managing your investment portfolio, regardless of your level of experience or financial situation. Whether you're just starting to explore the world of investing or you're looking to take your financial knowledge to the next level, How to Start Investing is the ultimate resource for anyone looking to build a secure financial future. So why wait? Start reading and start investing today. Chapter 1: Introduction to Investing. Investing is a crucial part of building and maintaining financial stability, but for many people, the concept of investing can be intimidating and confusing. With so many different types of investments, financial terms, and market trends to consider, it's easy to feel overwhelmed and unsure about where to start. However, investing doesn't have to be complicated or scary. With the right knowledge and tools, anyone can start investing and growing their wealth. The goal of this book is to provide you with the information and resources you need to get started with investing, no matter your experience level or financial situation. In this first chapter, we'll start by defining what investing is and why it's important. We'll then explore some of the most common types of investments and the basic principles of investing, so you have a foundation to build on as we move forward. What is investing? Investing refers to the act of putting your money into financial assets, such as stocks, bonds, and mutual funds, with the expectation of earning a profit over time. The idea is that your investment will grow in value, allowing you to sell it for more than you originally paid, or to earn income through dividends, interest, or other means. Investing is an important part of building and maintaining financial stability, as it allows you to grow your wealth over time and provides a means of generating passive income. This can help you achieve your financial goals, whether that's saving for retirement, buying a home, starting a business, or something else. Why invest? There are many reasons why people choose to invest, but some of the most common reasons include building wealth. Investing is a way to grow your money over time, allowing you to build wealth and achieve your financial goals. Diversification. By investing in a variety of different assets, you can reduce your risk and ensure that your money is spread across multiple investment types. Generating passive income. Investing can provide a source of passive income, allowing you to earn money without having to actively work for it. Protecting against inflation. Investing can help protect against inflation, as the returns from your investments may increase at a rate that outpaces inflation. Preparing for retirement. Investing is a key part of preparing for retirement, as it provides a means of growing your savings and ensuring that you have enough money to live comfortably in your later years. Types of investments. There are many different types of investments, each with its own set of risks and benefits. Some of the most common types of investments include stocks, also known as equities, represent ownership in a company and give you a share of the company's profits and potential growth. Bonds are debt instruments that allow you to lend money to a company or government in exchange for regular interest payments. Mutual funds are investment portfolios that pool money from multiple investors to purchase a variety of different securities. Real estate investments can include everything from buying rental properties to investing in real estate investment trusts. Commodities are physical goods, such as gold, silver, and oil, that can be bought and sold for investment purposes. Each type of investment has its own unique set of risks and benefits, and the right investment for you will depend on your individual goals, risk tolerance, and investment strategy. The basic principles of investing involves making informed decisions about where to put your money, based on your goals, risk tolerance, and investment strategy. To make these decisions, you need to understand some basic principles of investing, including risk and reward. Investing always involves some degree of risk, but the potential reward can be significant. It's important to understand the relationship between risk and reward and to make informed decisions about which investments are right for you. Diversification. Diversifying your investments is a key part of reducing risk and maximizing returns. This means investing in a variety of different assets, rather than putting all your money into one investment. Time horizon. Your time horizon refers to the length of time you plan to hold an investment. Long-term investments, such as stocks, tend to have higher potential returns but also higher risks, while short-term investments, such as bonds, have lower potential returns but also lower risks. Market trends. Market trends and economic conditions can impact the performance of your investments. It's important to stay informed about these trends and to make adjustments to your investment portfolio as needed. Tax implications. The tax implications of your investments can have a significant impact on your returns. It's important to understand the tax implications of each type of investment, and to consider these when making investment decisions. By understanding these basic principles of investing, you'll be better equipped to make informed decisions about your money and achieve your financial goals. Investing can seem overwhelming and confusing, but with the right knowledge and tools, anyone can start investing and building wealth. This first chapter has introduced you to the basics of investing, including what investing is, why it's important, and the basic principles of investing. As we move forward, we'll explore these concepts in greater detail and provide you with practical, actionable strategies for building and managing your investment portfolio. Chapter 2: Understanding your financial goals. Before you start investing, it's important to have a clear understanding of your financial goals. This will help you make informed decisions about your investments and ensure that you are working towards achieving your financial objectives. In this chapter, we'll explore the different types of financial goals that you may have and help you determine which goals are most important to you. We'll also provide tips on how to set and prioritize your goals, so you can start taking concrete steps towards achieving financial stability. Types of financial goals. Financial goals can be broken down into several categories, including short-term goals are financial objectives that you hope to achieve in the next 1 to 5 years, such as building an emergency fund or paying off debt. Medium-term goals are financial objectives that you hope to achieve in the next 5 to 10 years, such as saving for a down payment on a home or starting a business. Long-term goals are financial objectives that you hope to achieve in 10 years or more, such as saving for retirement or funding a child's education. When setting your financial goals, it's important to consider your current financial situation, your future needs and aspirations, and your risk tolerance. This will help you determine which goals are most important to you and which investments are most appropriate for achieving these goals. Setting and prioritizing your goals. Once you have a clear understanding of your financial goals, you'll need to set and prioritize these goals. Here are some tips for setting and prioritizing your financial goals. 1. Be specific. When setting your goals, be as specific as possible. Instead of simply saying, "I want to save more money," set a specific target, such as, "I want to save $10,000 in the next year." 2. Make them achievable. Make sure your goals are achievable and realistic. This will help keep you motivated and ensure that you are working towards goals that are attainable. 3. Prioritize. Prioritize your goals based on their importance and urgency. This will help you focus your efforts on the most important financial objectives first. 4. Review regularly. Regularly review your goals to ensure that they are still relevant and aligned with your current financial situation. By setting and prioritizing your financial goals, you'll have a clear roadmap for achieving financial stability and be better equipped to make informed investment decisions. Understanding your financial goals is a critical first step in the investing process. By taking the time to determine which goals are most important to you and setting achievable targets, you'll be better equipped to make informed investment decisions and achieve financial stability. In the next chapter, we'll explore the concept of risk tolerance and how it impacts your investment decisions. Chapter 3: Understanding your risk tolerance. When it comes to investing, one of the most important considerations is your risk tolerance. Your risk tolerance refers to your willingness and ability to take on risk when investing your money. Understanding your risk tolerance is key to making informed investment decisions and avoiding financial stress and anxiety. In this chapter, we'll explore the concept of risk tolerance and how it impacts your investment decisions. We'll also provide tips on how to determine your own risk tolerance, so you can make informed investment decisions that align with your financial goals and risk tolerance. The importance of understanding your risk tolerance. Your risk tolerance is a critical factor in determining the types of investments that are right for you. If you have a high risk tolerance, you may be more willing to invest in riskier assets, such as stocks or real estate, in pursuit of higher potential returns. On the other hand, if you have a low risk tolerance, you may prefer to invest in more conservative assets, such as bonds or money market funds, which offer lower potential returns but also lower risk. Investing in line with your risk tolerance is key to avoiding financial stress and anxiety. If you invest in assets that are too risky for your comfort level, you may become anxious about market volatility or the potential for losses. This can result in poor investment decisions and missed opportunities for building wealth. Determining your risk tolerance. Determining your risk tolerance is a personal process that depends on several factors, including 1. Age. Your age is a key factor in determining your risk tolerance. Younger investors may be more willing to take on risk, as they have more time to recover from any losses, while older investors may prefer more conservative investments as they near retirement. 2. Financial situation. Your financial situation, including your income, debts, and savings, can also impact your risk tolerance. If you have a high level of debt or limited savings, you may prefer more conservative investments, as you may not be able to afford the potential losses from more risky investments. 3. Personality. Your personality can also play a role in determining your risk tolerance. Some people are naturally more risk-averse, while others are more comfortable taking on risk. 4. Investment experience. Your investment experience, including your prior investment successes and failures, can also impact your risk tolerance. There are also several online tools and quizzes that can help you determine your risk tolerance, by asking you a series of questions about your financial goals, personality, and investment experience. Understanding your risk tolerance is a critical part of the investing process. By determining your risk tolerance and investing in line with your financial goals and comfort level, you'll be better equipped to make informed investment decisions and achieve financial stability. In the next chapter, we'll explore the different types of investments and the role they play in building a well-diversified investment portfolio. Chapter 4: Types of Investments. Now that you have a solid understanding of your risk tolerance, it's time to dive into the different types of investments you can make. The investment world can be a confusing place, with a wide range of options available, each with its own risks and rewards. In this chapter, we'll take a look at the most common types of investments, including stocks, bonds, mutual funds, exchange-traded funds, real estate, and alternative investments. We'll also explore the pros and cons of each type of investment to help you make informed investment decisions. Stocks, also known as equities, represent ownership in a company. When you purchase a stock, you become a partial owner of the company and are entitled to a portion of its profits. Stocks are considered to be a high-risk, high-reward investment, as the value of your investment can fluctuate greatly based on the performance of the company and the stock market as a whole. Bonds are debt securities that represent a loan to a company or government. When you purchase a bond, you're lending money to the issuer in exchange for a fixed rate of interest and the return of your principal investment at the end of the bond's term. Bonds are generally considered to be a less risky investment than stocks, as they offer a fixed rate of return, but they also offer lower potential returns. Mutual funds are professionally managed investment portfolios that pool money from multiple investors to purchase a variety of stocks, bonds, and other securities. The goal of a mutual fund is to provide investors with exposure to a diversified portfolio of assets, while also offering professional management and lower investment minimums than purchasing individual securities. Exchange-traded funds, or ETFs, are similar to mutual funds in that they provide investors with exposure to a diversified portfolio of assets. The main difference between ETFs and mutual funds is that ETFs are traded on stock exchanges, like individual stocks, and can be bought and sold throughout the day. ETFs also tend to have lower management fees than mutual funds. Real estate investments can take many forms, including rental properties, real estate investment trusts, and real estate crowdfunding. Real estate investments offer the potential for steady rental income and long-term capital appreciation, but they also come with risks, such as property management, tenant turnover, and market fluctuations. Commodities are physical goods, such as gold, silver, and oil, that are traded on financial markets. Investing in commodities can provide exposure to movements in the global economy and provide potential for returns, but can also be subject to price fluctuations and supply-demand imbalances. Cryptocurrencies, such as Bitcoin and Ethereum, are digital currencies that use cryptography to secure and verify transactions. Cryptocurrency investing can be highly speculative and subject to significant price fluctuations, and is generally considered a higher-risk investment option. Alternative investments refer to a wide range of investment options that fall outside of the traditional categories of stocks, bonds, and real estate. These investments can include commodities, hedge funds, private equity, and more. Alternative investments are often considered to be more speculative and higher risk than traditional investments, and are best suited for investors with a high risk tolerance. In this chapter, we've explored the most common types of investments and their pros and cons. By understanding the different types of investments available to you, you'll be better equipped to make informed investment decisions and build a well-diversified investment portfolio. In the next chapter, we'll discuss the importance of diversification and how to create a diversified investment portfolio that aligns with your financial goals and risk tolerance. Chapter 5: Building a Diversified Investment Portfolio. One of the key principles of successful investing is diversification, or spreading your investments across a range of different asset classes, industries, and geographic locations. By diversifying your investments, you can minimize your overall investment risk and increase the potential for long-term growth. In this chapter, we'll explore the benefits of diversification and how to build a well-diversified investment portfolio that aligns with your financial goals and risk tolerance. Why diversification is important? Diversification is important because it helps to minimize investment risk by spreading your investments across a range of different assets, industries, and geographic locations. When you diversify your investments, you're spreading your risk across multiple investments, reducing the impact of any single investment that may underperform. For example, if you invest all of your money in a single stock, you're taking on a significant amount of risk. If that stock performs poorly, your entire investment portfolio will be impacted. However, if you diversify your investments by investing in a range of different stocks, bonds, and other securities, you can minimize the impact of any single investment that may underperform. How to build a diversified investment portfolio. Building a diversified investment portfolio involves determining your investment goals and risk tolerance, and then selecting a mix of investments that align with your financial objectives. Here are some steps to help you build a diversified investment portfolio. 1. Determine your investment goals. Before you start investing, it's important to determine your investment goals, such as saving for retirement, purchasing a home, or building an emergency fund. Your investment goals will help guide your investment decisions and determine the types of investments that are best suited to your financial objectives. 2. Assess your risk tolerance. As we discussed in Chapter 3, it's important to understand your risk tolerance and how much risk you're comfortable taking on when investing. This will help you select investments that align with your risk tolerance and minimize the likelihood of losing money. 3. Consider your time horizon. Your time horizon, or the length of time you have to invest, is another important factor to consider when building a diversified investment portfolio. If you have a long time horizon, you may be able to take on more risk, as you'll have more time to recover from any short-term losses. If you have a shorter time horizon, you may want to consider more conservative investments, as you'll have less time to recover from any short-term losses. 4. Diversify your investments. Once you've determined your investment goals, assessed your risk tolerance, and considered your time horizon, it's time to diversify your investments. This can be done by investing in a mix of different asset classes, such as stocks, bonds, and real estate, and by investing in a range of industries and geographic locations. 5. Rebalance your portfolio regularly. As your investments grow and the market changes, it's important to regularly rebalance your portfolio to ensure that it continues to align with your investment goals and risk tolerance. This may involve selling investments that have performed well and purchasing investments that have underperformed, to maintain a balanced mix of assets. By following these steps, you can build a well-diversified investment portfolio that aligns with your financial goals and risk tolerance. Remember, investing is a long-term process, and it's important to be patient and consistent with your investments to achieve long-term financial success. In the next chapter, we'll discuss the importance of monitoring and managing your investments, and how to make adjustments as needed to ensure that your investment portfolio continues to meet your financial objectives. In conclusion, building a diversified investment portfolio is an important step in achieving long-term financial success. By understanding your investment goals, risk tolerance, time horizon, and investing in a range of different assets, you can minimize investment risk and increase the potential for long-term growth. Regularly monitoring and rebalancing your portfolio can also help ensure that your investments continue to align with your financial objectives. Remember, investing can be a complex and confusing process, but with the right knowledge and strategy, anyone can become a successful investor. By following the principles outlined in this book, you'll be well on your way to achieving your financial goals and securing your financial future. Chapter 6. Monitoring and managing your investments. Investing is not a one-time event, it's an ongoing process that requires regular monitoring and management to ensure that your investment portfolio continues to meet your financial goals. In this chapter, we'll discuss the importance of monitoring your investments and how to make adjustments as needed to ensure that your portfolio remains aligned with your financial objectives. Why monitoring your investments is important. Monitoring your investments is an important step in achieving long-term financial success. Regularly reviewing your investment portfolio can help you stay informed about the performance of your investments and make any necessary adjustments to ensure that your portfolio continues to align with your financial goals. For example, if one of your investments is underperforming, monitoring your investments can help you identify the problem and make the necessary adjustments to improve its performance. Alternatively, if one of your investments is outperforming, monitoring your investments can help you determine whether it's still a good fit for your portfolio and whether you should consider selling it to realize gains. How to monitor your investments. There are several ways to monitor your investments, including online investment tools, mobile apps, and regular portfolio reviews with your financial advisor. Some of the key information you should monitor when reviewing your investments include: 1. Performance. Review the performance of each of your investments to see how they're doing and whether they're meeting your expectations. 2. Asset allocation. Monitor the allocation of your investments to different asset classes to ensure that your portfolio remains well diversified. 3. Risk exposure. Review the amount of risk you're taking on with each of your investments to ensure that you're comfortable with the level of risk. 4. Rebalancing. Regularly rebalance your portfolio to ensure that your investments remain aligned with your investment goals and risk tolerance. 5. Market trends. Stay informed about market trends and economic news to help you make informed investment decisions. Making adjustments to your investment portfolio. As you monitor your investments, you may find that some of your investments are underperforming or no longer align with your financial goals. In these cases, it may be necessary to make adjustments to your investment portfolio. Some of the steps you can take to adjust your investment portfolio include: 1. Selling underperforming investments. If one of your investments is underperforming, you may want to consider selling it and using the proceeds to invest in other, more promising opportunities. 2. Rebalancing your portfolio. Regularly rebalance your portfolio to ensure that your investments remain aligned with your investment goals and risk tolerance. 3. Adding new investments. Consider adding new investments to your portfolio to improve diversification and increase your potential for long-term growth. 4. Adjusting your investment strategy. If your investment goals or risk tolerance have changed, consider adjusting your investment strategy to align with your new financial objectives. Monitoring and managing your investments is an important step in achieving long-term financial success. By regularly reviewing your investment portfolio, you can stay informed about the performance of your investments and make any necessary adjustments to ensure that your portfolio remains aligned with your financial goals. With the right monitoring and management strategies, you can maximize your investment potential and secure your financial future. Chapter 7: Common Investing Mistakes and How to Avoid Them. Investing can be a complex and confusing process, and it's easy to make mistakes that can negatively impact your financial success. In this chapter, we'll discuss some of the most common investing mistakes and provide strategies for avoiding them. 1. Not diversifying your portfolio. One of the most common investing mistakes is not diversifying your portfolio. By investing in a range of different assets, you can minimize investment risk and increase the potential for long-term growth. Consider investing in a mix of stocks, bonds, and other assets to create a well-diversified portfolio. 2. Timing the market. Another common mistake is trying to time the market, or attempting to buy and sell investments at the right time to make a profit. This is a difficult and often futile endeavor, as it's impossible to accurately predict market movements. Instead, focus on building a well-diversified investment portfolio and hold on to your investments for the long term. 3. Chasing high returns. It can be tempting to invest in high-return investments, but these investments often come with higher levels of risk. Instead of chasing high returns, focus on building a well-diversified investment portfolio that aligns with your investment goals and risk tolerance. 4. Not reviewing your investments regularly. Regularly monitoring and managing your investments is an important step in achieving long-term financial success. By not reviewing your investments, you may miss important information or opportunities that can impact your financial success. 5. Not having a long-term investment strategy. Without a long-term investment strategy, it can be difficult to achieve your financial goals. Consider working with a financial advisor to develop a personalized investment strategy that aligns with your investment goals and risk tolerance. Investing can be a complex and confusing process, but by avoiding common mistakes, you can increase your chances of financial success. By focusing on building a well-diversified investment portfolio, avoiding attempts to time the market, and regularly monitoring and managing your investments, you can achieve your financial goals and secure your financial future. Chapter 8: Opening an Investment Account and Getting Started. Now that you have a better understanding of the different investment vehicles and options available, it's time to open an investment account and start investing. This chapter will provide a step-by-step guide to opening an investment account and getting started with your investment journey. 1. Choose an investment firm. The first step to investing is to choose an investment firm. There are many investment firms to choose from, and it's important to do your research to find one that meets your needs and goals. Consider factors such as investment options, fees, customer service, and ease of use when choosing an investment firm. 2. Open an account. Once you have chosen an investment firm, the next step is to open an account. You will need to provide personal information and complete the account application. You may also need to provide proof of identity and income. 3. Fund your account. After your account is set up, you will need to fund it. Most investment firms offer multiple options for funding an account, including bank transfer, wire transfer, or ACH transfer. 4. Start investing. Now that your account is funded, it's time to start investing. Consider your investment goals and risk tolerance when choosing your investments. You may want to start with a diverse portfolio of investments, such as stocks, bonds, and mutual funds, to help reduce risk. 5. Monitor your investments. It's important to regularly monitor your investments to ensure that they are performing as expected and to make any necessary adjustments to your portfolio. Consider working with a financial advisor to help you make informed decisions about your investments. 6. Rebalance your portfolio. Over time, the composition of your portfolio may change as some investments perform better or worse than others. To ensure that your portfolio remains diversified and in line with your investment goals, it's important to regularly rebalance your portfolio. Opening an investment account and getting started with investing can seem overwhelming, but by following these steps and seeking the guidance of a financial advisor, you can take control of your financial future and work towards achieving your investment goals. Start small and be patient, as investing is a long-term strategy for building wealth. Chapter 9: Conclusion. In conclusion, investing is an essential step towards achieving financial stability and building wealth. Whether you are just starting out or have been investing for years, this book has provided a comprehensive guide to help you understand the basics of investing and make informed investment decisions. By understanding the different types of investment vehicles and options, as well as the importance of risk management, diversification, and tax planning, you can take control of your financial future and work towards achieving your financial goals. Remember to start small, be patient, and stay consistent, as investing is a long-term strategy for building wealth. We hope that this book has provided you with a solid foundation of knowledge and practical tips to help you get started on your investment journey. With time and practice, you will become a confident and successful investor, ready to make the most of your financial opportunities and achieve financial independence. This book that was authored by Open A.I.'s ChatGPT. With the company taking on billions of dollars in investments, this is the perfect time to find out ways for this innovative tool to help you learn how to write a business plan. Audio for this book was provided by NaturalSoft Limited's Natural Reader AI software using their commercial license. Per their website, this license allows you to use its software and voices for commercial or public use. This includes, but is not limited to, YouTube videos, public announcements, broadcasts, and e-learning.